Welcome, everyone. Today, we're putting on our expert investment analyst hats to break down a literally massive pivot. We're looking at Quantum Computing Inc., ticker symbol QUBT, and their incredibly aggressive leap from lab prototypes straight into industrial manufacturing. Now, in this explainer, we aren't just going to geek out over the tech. Oh no, we're running a complete stock analysis using the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, right alongside some discounted cash flow models, which, if you're new to that, just estimate an investment's value based on expected future cash flows, all derived directly from our source data. So, if you love a deep dive into bleeding-edge tech combined with rigorous financial valuation, you are in the exact right place. Let's get into it.
Here is our roadmap for today's explainer. Number 1, the Q1 financial shockwave. 2, fueling growth through acquisitions. 3, physical scaling and foundries. 4, balancing the balance sheet. And 5, the future quantum horizon.
Okay, section 1, the Q1 financial shockwave. Because look, the first quarter of 2026 really represents a fundamental, ground-up shift for QUBT's entire financial reality. Boom, 9,364%. That is QUBT's year-over-year revenue jump in the first quarter of 2026 alone. I mean, extraordinary numbers like this, they rarely happen organically. And as an analyst, seeing a jump like that immediately makes you sit up, pay attention, and look for the catalyst.
Because the stark contrast here is just incredible. We're talking about going from a meager $39,000 in revenue back in Q1 of 2025 up to a staggering $3.69 million in Q1 2026. But, we have to look at the whole picture. The operating loss expanded from $8.3 million to $20.55 million over that exact same period. Net loss came in at $4.1 million, which is negative 2 cents per share. So for those of you tracking owner earnings, Warren Buffett's classic metric for the actual cash a business generates for its owners, this presents a pretty immediate hurdle. The company is burning a significant amount of cash to achieve this massive top-line scale.
But here is where the story gets a massive safety net. QUBT is sitting on $1.4 billion in cash equivalents, and investments. From a Peter Lynch perspective, assessing the balance sheet is absolutely step one for finding a turnaround or a fast grower stock. With total liabilities sitting at just $23.4 million against $1.6 billion in total assets, QUBT boasts a practically flawless balance sheet. It provides them a huge runway to fund operations without any near-term financing anxiety. Seriously, if you're an investor looking for a safety net in an otherwise highly volatile tech sector, this balance sheet is exactly it.
Section 2, fueling growth through acquisitions. So how exactly did they buy that massive revenue leap we just talked about? Let's transition over to the M&A activity that entirely rewrote their playbook.
When Warren Buffett evaluates a company, he is always looking for honest, highly competent management. Enter Dr. Yuping Huang, who was recently appointed as permanent CEO. Dr. Huang isn't just your typical corporate suit. He's the founding director of the Center for Quantum Science and Engineering over at Stevens Institute of Technology. Buffett absolutely loves competent management, and here you have a pioneering physicist with over 20 years of research architecting an aggressive corporate transformation.
Under his watch, QUBT deployed capital, and they deployed it fast. They executed a $110 million all-cash acquisition of Luminar Semiconductor, which brought in established, ready-to-go capabilities in lasers and advanced packaging. Then they followed that right up with a $5 million acquisition of NuCrypt for quantum communications. So looking through a Peter Lynch lens, QUBT falls squarely into the fast grower category now, those aggressive, high-growth stocks he really favored for massive returns. These acquisitions, they didn't just buy concepts. They bought immediate manufacturing capabilities, existing hardware sales, and some incredibly crucial engineering talent.
Section 3, physical scaling and foundries. Let's shift from the financial engineering side to physical reality and see how this actually builds their economic moat.
Buffett demands a strong economic moat, right? Well, for QUBT, that moat isn't just a bunch of abstract patents, it's a tangible physical infrastructure spread across 6 different states. Take a look at the Fab 1 facility in Tempe, Arizona. They're already ramping up small batch manufacturing of thin-film lithium niobate chips there. They aren't just sketching out quantum concepts on a whiteboard anymore, they are fabricating the physical architecture.
And what does all that physical fabrication actually create? The direct 3. And the absolutely crucial point here is the phrase room temperature. Most quantum computing requires massive, incredibly power-hungry supercooling setups. But the direct 3? It operates efficiently under 100 watts right at room temperature. They've already deployed it on the commercial quantum corridor network. This technological advantage, being scalable by design and having super low power consumption, is a massive protective moat against their competitors.
Moving on to Section 4, balancing the balance sheet. It is time to crunch the numbers and balance the realities of rapid scaling against the actual market risks. So let's apply Benjamin Graham's defensive investor checklist here. Adequate size and strong financial condition? Yes, absolutely, with $1.6 billion in equity and that $1.4 billion in cash. But what about earnings stability and a moderate PE ratio? Yeah, that's a hard fail. Earnings are currently negative. In fact, if we try to calculate Graham's intrinsic value formula, which involves multiplying EPS by book value, we hit a literal mathematical wall. Because the EPS is -2 cents, the formula just breaks down. Actually, Graham would probably just say there is zero margin of safety here based on historical earnings. So the big question is the risk of building foundry capacity faster than actual market demand materializes too high? Because that $19.8 million in Q1 operating expenses certainly highlights that danger.
But hey, valuing a fast-growing tech stock requires forward-looking models, not just historical ones. So let's look at the discounted cash flow, or DCF perspective, provided by Simply Wall Street's data. According to the sources, forecasts are projecting $17.3 million in revenue and $1.1 million in earnings by 2028. Based on these projections, the models yield a fair value estimate of $23.67 per share. With the stock trading around the $10 to $12 mark recently, that implies a massive 126% upside. But keep in mind the sensitivity here. This assumes an incredibly aggressive 216% yearly revenue growth. If the conversion of their backlog slows down even slightly, the terminal value in that DCF model, meaning the estimated value of the business at the end of the forecast period, absolutely plummets.
Finally, Section 5, the future quantum horizon. Let's bring all these frameworks together and get our final verdict.
Management's next steps are pretty clear right now. Refine Fab 1, plan a high-volume Fab 2, and above all else, convert that $16 million contract backlog into recognized recurring revenue. So what's the synthesis of our whole investment analysis today? Well, Benjamin Graham would label this as a sell or an avoid. It's just way too speculative without those historical earnings. Warren Buffett would likely rate it a hold or a wait. He'd love the balance sheet and the room temperature moat for sure, but he would demand consistent owner earnings before actually buying. But Peter Lynch? He might actually see this as a speculative buy. It's a classic fast grower with a turnaround flavor, fueled by M&A, and backed by a massive cash safety net that almost entirely eliminates any near-term bankruptcy risk.
Which leaves us with the ultimate question. Will QBT's $1.4 billion war chest actually be enough to fund the gap between bleeding-edge physics and, actual sustainable profit? They have the talent, they have the physical footprint, and they certainly have the capital. Now they just have to execute. Thank you so much for joining me on this deep dive into Quantum Computing Inc. Keep learning, keep analyzing, and I'll see you in the next explainer.